Well, good morning, everyone. I want to welcome everyone and thank you for joining us today for our call on new sales concepts to help uncover potential gaps within your client's retirement strategy. My name is Tom Vukovic. I head up the Financial Products Division with Insurance Network America. And as always, we are committed to providing you with new ideas, great ideas to help continue the conversations with your clients and build your business. We've got a terrific turnout today. I see a lot of familiar names. I want to thank you all for your continued partnership. I also see a lot of new names with us today, and I want to thank you for joining us and welcome you. I strongly encourage you to contract with Insurance Network America. Following the call, we will be reaching out to you, but if you have a case you're working on, if you want to talk more about our solutions, if you have thoughts on the upcoming Department of Labor and the fiduciary rule and questions regarding that, we've got all the solutions you need. Reach out to us. Our number is 800-456-7999, and we intend, just a quick preview, commercial for an upcoming call on the 21st of March. We have a Department of Labor call for you that we're hosting to not only provide an update to our previous call about a week and a half ago, but we are going to provide an update on the latest information on what's going on and what this all means to you. And we are a true partner here to help you. So during today's call, if you have questions along the way, please use GoToWebinar to submit your questions. And I will do my best to pass those on to our featured speaker today, Paul Huber, and we can answer those as we go along. So at this point, I would like to introduce our outstanding partner, Paul Huber. He's the Regional Director of Sales for Allianz Life, and he's got a lot of great tools and marketing materials that I'm sure you'll find useful in your business, and we can get these in your hands following the call. So without further ado, Paul, thank you so much for joining us.
Thanks, Tom. Appreciate it. Good morning, everybody. Thank you very much for joining us. I always appreciate that every minute that you spend on a call like this is time that you're not in front of your clients and customers. So we try to make it worthwhile. We try to make it light, valuable, and talk about something that you can help apply to your business right away. And hopefully we can accomplish that objective today. So talking about helping filling gaps in retirement, today what we're going to do is introduce our Life as our L.I.F.E, or Life as a Financial Engine kit that we have available. Now, to be completely honest with you guys, life insurance as a financial engine is basically the closest we could get without compliance having a fit of saying, hey, life insurance should be recognized as an asset class for your clients. As we're looking at diversifying and setting up different buckets of money and different strategies, life insurance should be a key part of their plan, not only for the death benefit part, but for many clients as the cash accumulation part. One of the things that I've been here at Allianz 15 years, I've spent the last 12 or so on the life insurance side, really as we completely overhauled our product portfolio, got into the indexing side of things, and really focused on cash accumulation life insurance using indexing. The one thing I can tell you is from 12 years ago to today, your clients definitely are looking for collateral and information that help explain why this makes sense, right? Now, it's not as hard as it was 12 years ago when I was calling advisors like yourself, and you're going, what the heck is FIUL? I've done universal life insurance. I'm never going back. But you still have a lot of people that don't get it, or they're starting to hear about it, and having a carrier piece talking and explaining them the details is really valuable for you. So this is one of I think, a handful of our kits that we have. Not only do we have the Life kit that we're going to talk about today, we have a Success with FIUL kit that is more of an indexing 101 kit. We have a policy review kit. We have a small business kit, some college planning type pieces and kits. And all these kits can be kind of intermingled as you're meeting with the people that you talk to day in and day out to answer their questions. It's really important to get collateral that you can put in front of your clients and be client approved. So that's what we're going to go through today. specifically talking about our newest kit, which is life insurance as a financial engine. And then we'll finish up with a couple changes that we had to the product last week that we kicked off. So, and if you do have any questions, feel free to type it in the box there. Tom will be breaking in if it's something pertinent to what we're talking about, or when we finish this, which should be in the next 25 minutes or so, we'll definitely get to any questions that you may have. So without further ado, let's jump into the kit. Let's talk about IUL real quick. Why it makes sense as you know, basically a strategy for your clients. It really has those three components there. You have the protection, the death benefit protection that it offers your clients, right? Nothing is better than life insurance when it comes to passing on money to your beneficiaries. You have young clients that are looking to protect their family, protect their income, take care of debt, that sort of thing. Life insurance does that. Flexibility. Flexibility from a premium standpoint and flexibility from a taxation standpoint, which we'll get into in a minute. And then looking at the tax advantages. You're growing your money tax-free. You're passing that death benefit on tax-free to the beneficiaries. And hopefully if we use this before you know, we pass away, we're accessing that cash through tax-free loans, you know, which is going to be beneficial to your clients. And we'll get into some of those scenarios here in the future. So once you get your kit, you're going to see a number of, like I said, client-approved pieces out there. Impact of dying too soon. We're going to go through this piece a little bit in more detail, talking about flexibility and control. You know, comparing things like a savings account or a CD or money market that maybe you're taxed every year on, or looking at something that's tax deferred, or looking at something that's tax deferred up front, like a qualified annuity or a 401k, but you're taxed on the back end, and having those conversations with your clients about what is right for them and what is the strategy that they need to use. And maybe they've been doing something for a long time, for 10, 20, 30 years. Maybe it's a good time for them to make a shift, put some eggs in a different basket to make sure that, you know, I look at my mom. I sat down and had a conversation with her. She's 68 years old, retired. And every dollar that she has that she's accessing is either her Social Security or qualified money from, you know, whether it's a pension or whether it's a 401k that she rolled over. And you know, coincidentally, when I had my tax meeting with my tax professional, hers was the meeting before me. So she sat around and waited for me. And you know, we share the same tax advisor. And he said, hey, keep in mind as your mom starts taking out these distributions, she's going to be taxed on it, and it's going to be a greater impact to her. Well, that's because she has all taxable funds coming out in retirement. If she had another vehicle that she could access tax-free, if she had a life insurance policy, something like that, you know, that could change her situation, and she could help offset some of those tax penalties that she's going to face next year. So as we're talking about this, write a handful of clients down that you're thinking about that you can start conversations and start talking about some of these. We'll get into filling gaps in retirement strategies, how to make your idle assets go a little bit further, using something like our premium deposit account to access that money that might be sitting in a, you know, maybe a CD or sitting in a money market account that's just on the sidelines, not doing anything with. Frankly, with still having the low interest rates, you know, we can be doing a lot better, not to mention if they're never planning on accessing that money, let's pass it on through death benefit. Let's get them, you know, more bang for their buck using life insurance. There's going to be a piece in there. This is the only piece that is not for your clients, is for you. Talking about the different, you know, the different clients that you're dealing with, and seeing where it fits and what makes sense for them. Right. As we look at this, you can see we have the Henrys, high earners, not rich yet. Right. People who are in a successful job career, but they don't have a large net amount of risk. What are their concerns? They're looking at, you know, they're not concerned with how long their retirement is going to last, because they have a long time before they hit that goal line. But they are looking for flexibility and control of that policy. You know, overfunding when they get those bonuses, or have good years, or maybe backing off when you're paying for college or other things that happen in life. They are worried about dying too soon, because if they do pass away too soon, A, they have to worry about that income not going on to their spouse. They also have to worry about the, you know, the savings that they were putting away for the retirement, and that bucket might not be as great as they thought it was going to be down the road. Let's look, you know, compare that to, we have the affluent people who do have the discretionary income to put in large contributions, people looking for alternative resources, whether it's supplemental retirement and that tax-free loan portion of it. The transition boomers are a good comparison to our Henry clients. Transition boomers are those clients that are 55 to 65. They're working that last 10 years of their life typically. Those last 10 years are going to be their highest earned income, generally speaking. And because they're getting their highest earned income, and they're also at, they're in the red zone, to use a football term, and they see the goal line, they know that we need to really start packing away money for retirement, which is coming, quicker and quicker and quicker. So how long will their retirement assets last? Absolutely, they're concerned with how long it will last, because they're seeing how long it's going to take and wondering what's going to happen. They're not going to have as much flexibility because they need to put as much away as they can in a short amount of time. They are worried about dying too soon, because if they do pass away in those last 10 years, again, those are the 10 years that they really start to put on, a lot of money into those plans. Those final, you're like me, a procrastinator. You wait, and all of a sudden, boom, you're there, and you got to really make hay. They do have idle assets. They have been saving. They probably have inheritance or other money that they've saved in the past on the sidelines, and they're worried about filling in the gaps for their retirement, right? Do they have qualified money? Are they looking at bridging the gap between, when they retire and maybe when they start Social Security, or how are they going to pay for, insurance up until they qualify for Medicaid, that sort of thing. These are all the questions that your clients are going to have, and having an IUL policy in their back pocket with cash value is going to allow you to really be flexible and provide some of those solutions for your clients. So let's talk real quick about filling the gaps. One of the pieces is going to be filling the gaps, and it looks at a number of different buckets. So you have your lifestyle bucket, you have an emergency bucket, you have a legacy bucket. And as we go through it again, I mentioned this, that we have, with life insurance, specifically with FIUL, a tax-free death benefit that's going to pass on to the beneficiaries. We have tax-deferred growth in the policy, right? We have indexing, which means that we're never going to lose any money due to market loss, but we are going to experience those upside gains based on the index and the caps. And then when we take the money out, if we use those loans that's available through the policy, we can access those loans tax-free. So looking at lifestyle, are your clients looking to supplement retirement income? Are they looking to pay for college? Do they want to pay for a child's wedding, or help them make a down payment on their first house? Whatever the case may be, this is one of those lifestyle buckets that you can plan for. You're putting the money in, you have it there. Whenever you need it, it's there for you, and you can access it. There is a piece that we won't go over today, but I'll talk about it briefly, that's inside this kit that goes through different strategies of accessing your money, looking at having a lump sum of money sitting out there, and when do you decide to use the life insurance policy. I believe how it's set up is it gives you 3 examples. One, you're just taking out money in your 3% out of your assets for the rest of your life. But what happens when you start factoring in sequence of returns? You talk about the 4% rule, or now it's 3, or maybe even 2.5, whatever you think it might be, for your client to manage their money and get to the end of their life without spending too much. And taking zeros out and taking a large lump sum of money out of that can be detrimental to a policy if you start to have some really negative years. Maybe having a life insurance policy to jump in and take money out in the down years and not add a double negative really to your bucket of cash could help you go a long way. So it lays it out very neatly for your client on having a life insurance policy there as a backup can really be beneficial. Emergencies, whether it's medical bills, illness, car repairs. Last year, my driveway was falling apart. Tom, do you have any idea what it costs to pour a concrete driveway in Minnesota? It's ridiculous. It was the greatest thing I ever did, but I still look down at the driveway and say, wow, there's $10,000 that I park on every day, and it's one of those things you got to have, but at the same time you don't want to pay for, right? Exactly. Having a life insurance policy that you can go access for the need, right? You don't have to go take a loan out. You don't have to put it on a credit card, whatever it may be. You have flexibility to get to your money for what you need it, why you need it, no questions asked. And then legacy. passing it on to the kids as beneficiaries or charities, whether it's a church or a group that you're involved in, that you want to make sure your legacy continues. These are things that are important to your clients. Up here in Minnesota, we have tons of lake homes and cabins, and that's a hard thing to pass on when you have multiple children, right? And depending on what they do, just the taxes alone on some of these places, and they might have bought it really cheap years and years and years ago, and now it's worth hundreds of thousands of dollars. So having life insurance to help offset some of those costs for your family will make sure that the kids and the grandkids can continue using these places instead of having to sell it just to be able to afford the taxes and the bill that comes along in your passing. Some considerations you want to keep in mind. Obviously, if you're taking out policy loans, you got to remember that it is going to reduce your cash values in your policy. It's going to reduce your death benefit because your death benefit is paying off the loan. If these policies ever do lapse or crash, there could be a potential taxable situation. And obviously, when we speak about income, that income is not guaranteed. So keep that in mind. Now that we satisfy compliance and all the scary what-ifs, I'll let you know that we do have a team here available, and it's growing and growing and being put into place now that when your clients do start taking loans from our policies, there's going to be somebody here that can help make recommendations to you or to the client, whoever happens to be there, right? If you're selling me a policy and you're 60 years old today and I'm 38, in 30 years when I access this policy, you're going to be retired on a beach in Hawaii and you might not be there to help me out. That's where Allianz can step in and say, here's the illustration, Paul, that you showed. They showed you at 6.5%, and here's your income. Let's help you through it. Your policy did better or did worse, and here's what you can take out for a loan. Here's your choices. And if you do take this much, here's the impact it's going to have on your policy. We will be there to help support the clients. Looking at the impact of dying too soon. Obviously, it's important when you're planning to say, what are my goals? What am I trying to save for? What are the objectives? Am I putting money away for my kids in college? Am I looking at my retirement? I have a house, a mortgage, a second property, whatever it is. I need to make sure that if I don't make it home tonight, my wife doesn't have to worry from a financial standpoint, that she knows that she can stay in the house we're in. They can go on vacation where they're planning on going on vacation. My kids can go to the schools or the colleges they want to. All those are going to be choices that hopefully we'll be there for because we plan properly with life insurance. So let's look at an example real quick. This is a piece that's inside because you may have somebody that says, well, Paul, I don't need life insurance because I'm putting money away into a policy. So in this chart right here, this is a piece that will come right out of the kit. You can sit down with your client. They're saying, I'm putting $24,000 away for my retirement every year. So I'm really insuring myself. I'm going to have plenty of money. I'm going to have plenty of retirement money. Let's look at this from age 40 to age 60. Now, this is going into a policy. We're contributing at 7% assumption, and we're compounding it annually. So pretty simple and straightforward. I don't think there's a whole lot of policies out there that are going to necessarily do this for them with not having any downside risk or protection, but let's just hypothetically say they can do it. So they're putting in $24,000 every year. Fast forward to 5 years, they have $75,000 put away in this policy. Well, boom, what happens if they walk outside, they get hit by the proverbial bus? They are gone. What do they leave for their family? $175,000, right? They're not putting away that much. Here in Minnesota, that might take care of their mortgage, but is that going to make up for the income? They're 45 years old, so that means that their kids aren't even in college yet, most likely. Maybe it's paid for part of the mortgage, but now you have a single wife or a single husband, one income, trying to do everything, and that is really not planning and taking care of your family for the future. Not to mention, you're going to have less from the retirement side of it. And fast forward and look at that number of year 25. So let's say they do make it to retirement. They have $1.5 million. We'll round up on the marketing. That's what we do. So remember that number, $1.5 million. As we switch over to the next slide and look at what if we take that and put that into an IUL policy. So we're putting in $24,000. Right away, we're going to get them a $1 million death benefit. So fast forward to year 5, that unfortunate bus accident occurs. They have $1.1 million that's now going to their beneficiaries, right? That's a significant increase that they're going to have help not only pay for any debts, make up for lost income, take care of that family, and go above and beyond what that $175,000 would have done in just the straight retirement policy. Now, if we fast forward it to age toward year 25, which would be age 65, you can see my cash value on the non-guaranteed side is $2.2 million. I've run the numbers, I've run this illustration, and what you'll find out is the income that this client can take based on 6% is somewhere in the neighborhood of $113,000 a year, tax-free for the rest of their life, at 6%, not 7, just a nice, I would say low from an IUL standpoint illustration at 6%. So $113,000 from age 66 to age 120. They're never going to run out of income, and they're going to have a death benefit at some point that goes to their beneficiary as well. If we go back a slide, we look at that $1.5 million, and let's use that rule of 4, right? Again, everybody I've talked to, if you say 4% is what you can access, they say, nope, that's not the case anymore. They still throw that number around, but the chance of success is down greatly. A lot of people will say it might be 2.5 to 3. But let's just, for argument's sake, say it is 4%. 4% of $1.5 million is going to be $60,000 a year. So you can take out $60,000 a year out of your $1.5 million and maybe make it the rest of your life. Or we can look at the life insurance policy where you had that tax-free death benefit during those savings years as protection for you, and you're also getting that $113,000 plus, with the chance of possibly more, and that's tax-free. Almost double the income coming out of the life insurance policy as your vehicle that you're earning, which again is a fictional vehicle. I don't have a vehicle out there that's going to do exactly that. So a nice way to start talking to your clients about, yeah, I understand you're saving money for retirement, but let's kill two birds with one stone. Let's put money away not only for your retirement, but let's put money away for your life insurance policy as well. Looking at different goals, talking about protecting your future if they die too soon. We went through that. We talked about the bucket list and going through asking your clients what is important for them. What do they want to make sure they cover? Think of 5 clients. I mentioned before, think about clients that this may fit into. Have you thought of some clients that maybe they have some need? Maybe they're in that transition boomer year, right? Maybe they are looking at saving as much as they can for the next 10 years. Maybe they have children that fall into that Henry bucket, or those Henry clients that are looking to start saving. Write that down. Make sure you're reaching out to them. Let them know you have some ideas. You'd love to talk to them. The more you can get out there and start talking about life insurance, the easier it's going to be, the better it's going to be for you. And again, whether it's talking about the bucket list strategy or talking about the impact of dying too soon, and incorporating the sales pieces that are part of the life kit can be really beneficial in starting those conversations. Now, to shift gears a little bit, we did have some changes made to our Life Pro Plus policy. I guess before I do that, after I wrap this part up, I'll kick it back over to Tom. For if you guys want to get your hands on that life insurance as a financial engine kit, it is available to you. Tom will come back with the phone number. If you call INA and speak to your rep over at INA, they can get you out not only the Life Pro Plus brochures, but also any of the sales kits we talked today, but more specifically that life insurance kit. So before we get over to there, let's just talk real quick on some changes we've had. Some very positive changes to what's already one of the best index policies out there in the market. We had some caps go up. We saw the blended index increase, so the cap on the blended index is now 15%. And we saw the Barclays U.S. Bond Index, or the BUDB2, go up to 145% participation rate. That is the uncapped volatility controlled index. So remember, on the life insurance side, you have no spread on that. It's uncapped with a 140 par rate. If you're interested, we do have a high par rate looking at the true balance crediting method, which is a 7% cap with a 200 par rate. A lot of different choices depending on what client that you're looking for. So as of March 7th, we had those cap changes increased. The other thing we did is one of the things, I caution you, There's a lot of new products that are coming out there, and this is all on the heels of AG 49. If you guys were part of my breakout groups that I did with INA both this past August or September and the year before, we talked about AG 49, which was the rule regulation that came through on IUL and how we credit interest rates and how we really cap participating loans and the bonuses and everything else. What that rule regulation spawned was, because it limited everybody's upside potential or showing, higher interest rates based on performance, companies came up with bonuses on their policies or different ways. Now these bonuses, are kind of twofold. One, some companies reserve for it, other companies don't. Some companies guarantee it, and other companies don't. The bonus we came up with last May is a multiplier bonus. It starts in the 10th or after the 10th year, so in year 11 going forward. And what we were doing is crediting 15% of your index gain back onto your policy. It had a 1% cap on it. So essentially, if you did a 20% return, you could cap out, get a 21% return at year 11 going forward. As of March 7th, we removed that 1% bonus restriction on the policy, and we went back to all the policies of version 7 that have this bonus on it. So if you sold a policy earlier this year or up to last May, that bonus, you're going to get a letter that it has been removed. So looking at it now, the way our bonus works, policy year 11, if you get an 11% return, your client will see a 1.65% return. Now the downside is if it's 0, they will not see a gain that year from a bonus standpoint. But at 8%, they're getting 1.2%. At 4%, they're getting a 0.6% bonus. It's a true uncapped bonus that's tied based on 15% credit of their index gain. Locked in, contractually guaranteed, so we cannot lower that 15%, and we will not remove the uncapped nature of that for your client. The reason I mention this is that we do have some competitors that came out with new policies here in the last month. They have bonuses that are tied to their policies, and their bonuses are making the policies look fantastic. However, we have absolutely no ideas how the bonuses work, and the bonuses are not guaranteed whatsoever. So one of the things that we pride ourselves here at Allianz is having a guarantee. A promise is a promise. That's what we've always stood by. So you have this, you know what it is, and also transparency. You know what your bonus is. You can explain it to your client. They're going to know what it is. They're going to know what to look for, as opposed to some of these new bonuses, which truly are black box. We have our actuaries looking into them and them just shaking their head saying, we don't know what the moving pieces are, and it's essentially turning it into almost a dividend, which is, does the company want to pay it or not, and it's up to them. So the biggest thing I would say is ask questions as you're seeing illustrations and you're seeing something looking too good to be true, or this bonus looks fantastic. Ask why. Again, I like transparency. I like to be able to explain it to my client. I think with indexing you get that. You see what the index credit is. You know how it is. You're choosing it. And same thing with our bonus. You're going to have that opportunity with your bonus. So with that, I will kick it back to Tom. If you have any questions, please feel free to type them in. Tom, I'll stop showing my screen so you can pull yours up.
Oh, you're fine, Paul. You can leave your screen back on. Oh, well, that's fine. All right. Well, thank you, Paul. Nice job rolling out the pieces we have. If you want to get your hands on this and you have a client in mind, a case in mind you want to talk don't hesitate. Give us a call. Again, the number is 800-456-7999 for those of you that don't have our number. As you can see, we are committed to bringing new ideas, new concepts to you. If you have a case you want to talk about, we'll certainly make the time and provide the live voice to help you regarding that. Our sales team will be following up with you within the next day to provide you these tools and get these in your hands. Again, don't wait if you have a case you want to talk about. If you're not contracted yet with us, I want to encourage you to take a look at us and really side with a partner that's there to help you and your clients and put you and your clients first. Again, we have a Department of Labor update call I want to throw out there for March 21st. It is a repeat of some of the information we've had in the past, but we're also going to discuss the most recent updates. So please look for that. Talk to your marketer and look at our website also. One other thing I want to point out, Paul talked about different needs for your clients in retirement. One thing that I think needs to be out there is the cost of health insurance in retirement. That's another need that you need to make sure that you're bringing up with your clients. How are they going to fund that? How are they going to cover those expenses? Between 5, 8, 10,000 a year for an average couple during retirement, and that's out-of-pocket expenses beyond Medicare. I don't see any questions at this point, Paul, but if you have questions, we will be following up or reach out to us. We have the right solutions, the right contracts, and the right people to help you. Again, our number is 800-456-7999. And want to thank everyone again for participating today. I want to thank Paul for making the time to provide the details, information, sales ideas to help you build your business. So without any further ado, everyone have a great Wednesday, and thank you for making the time.
Thanks, Tom.
Thank you.